Welcome to AllGen's Market Update. My name is Jason Martin. Today is February 28th, 2020. A lot of things going on in the news this week with the coronavirus and the COVID-19. So we wanted to address some of those concerns and give you an update on the market, what we're doing about all of this, and keep you informed. So let's look at the bullet points we're going to cover. Number one, these type of epidemics or pandemics, whatever you want to call it, are historically short-lived. And I'm going to get into a chart that kind of shows historically a lot of different epidemics that have occurred over the years. Our portfolios have been, even prior to this, defensively postured. That has helped us to hold up much better than the market as the market has dropped. Then we're going to talk about historically how panic-driven drops, and this has caused a lot of fear recently, but those panic-driven drops typically are great buying opportunities. And then I want to give you some tips to stay the course and to help you build wealth over time, regardless of what comes up in the news or throughout your lifetime, so that you don't make a bad mistake. So let's hop right in. So this is a chart, a little bit busy, but it just shows you historically there have been quite a few epidemics, and just maybe a few of these ring a bell. You had HIV/AIDS in June of 1981, you had the pneumonic plague in 1994. I remember pretty clearly the SARS in April 2003. You had the avian flu, the dengue fever, swine flu. Any of these ring a bell? You had MERS, cholera, Ebola. How about some of the more recent ones, like the Ebola in 2015, Zika in 2016, and then most recently we have the coronavirus. The point I want to bring up here is that every time that we've had these, if this chart right here shows what the returns of the market have been one month, 3 months, and 6 months afterwards. On average, after all of these epidemics, the market has been up on every single time frame. The 1 month time frame, the 3 month time frame, and the 6 month time frame. And on average, 6 months later, the market has been up 8.5%. Doesn't mean every single occurrence has been up, but even the worst occurrence, which was the pneumonic plague, back in 1994, the market was down 4.3% 6 months later. So the point of me bringing this up is, we're not trying to make light of the virus itself. It's just that we are trying to explain historically these things happen. And the market typically recovers from it. So let's hop on to the next slide here. Just to kind of let you guys know, the way we've positioned the portfolios, and it wasn't even specifically planning on the coronavirus, but we were planning on just the market being overvalued and a couple other red flags in the economy, is that we have lowered our position in stocks, reduced our position in stocks, and we've increased bonds, and specifically long-term U.S. government bonds. We also added gold to the portfolio last year, and we have a little bit of cash in the portfolio as well. So I wanted to briefly touch on how each one of those areas have done, because when you see in the news how bad the market is down, a lot of times they don't talk about what is going up. And so yes, the S&P 500 as of today, and as of the time of this recording, is down 15% from its all-time record high that was set a week ago. But aggregate bonds are actually up 1.3%. So your core bond piece of your portfolio is up 1.3% on average. Long-term U.S. Treasury bonds are up 6.3%. The majority of our portfolios have at least 8 and sometimes up to 12% of their portfolio just in long-term U.S. Treasury bonds, not counting, and that's on top of the just core bonds that they hold. Gold up until yesterday was up. But as of today, gold is flat and cash is flat. So you have stocks that have gone down quite a bit, but you have bonds that have gone up, and specifically long-term Treasury bonds that have gone up a good amount, and you have gold and you have cash that have stayed flat during this time and have not decreased. So we're big believers in diversification, and we're big believers in buying assets that are non-correlated, which means you may have one thing go down, but another position go up. And that's the key to success over time. Not only having a diversified portfolio and also non-correlated assets, but then consistently rebalancing. So for example, it may be a good point in the next couple weeks where we sell some of our bonds and buy stocks that have gone down. And you constantly rebalance. Like, maybe at the end of 2019, as an example, you sell stocks and buy bonds because stocks were up a lot. But we constantly do that rebalancing in our portfolios. And just to reassure you guys, we are defensively postured. I have looked at all of our different risk profiles and all of our different portfolios compared to the respective benchmark. So an aggressive portfolio versus an aggressive benchmark. And we are holding up significantly better than the benchmark year to date, despite this market drop. So I'm very pleased that we've been defensively postured, and it's helped us to hold up the portfolios better than what the market has done. Okay, so this chart is a very interesting chart. It goes back 20 years, and what it's pointing out here is what happens to the market when there is a lot of fear. Okay, what we're specifically looking at here is the S&P 500 is the top chart, and then you have the volatility index, which is nicknamed the VIX, and a lot of people call this the fear indicator, at the bottom here. And the way you read this, and I've showed this in past market updates, is when this volatility index gets above 40, which is this blue horizontal line here at the bottom, you've reached an extreme point of fear. We went above that today. We were very close to it yesterday, but officially the volatility index has gone above 40 today. So we're now in that extreme fear level. So what I've done here is I've marked on this chart these yellow yellow vertical lines are marking out every time the the volatility index and the market has gone through a lot of extreme fear. Okay, so if you look in 2001, this was a classic example. Where September 11th happened, and that was certainly an extreme level of fear. Well, the market went down a lot on that fear, but look what happened afterwards. It had, over the next 6 months, it actually rallied after that fear. Okay, and then you had 2002 and 2003. That's the bottom of the tech bubble. The market, high fear again. Market reached a low point, and it rallied afterwards. Then you had 2008, and the worst time of its fear was right here in kind of October, November of 2008, and you still were above 40 all the way to March of 2009. But historically, that would have been a great time to purchase. Okay, then you had these other occurrences. Interesting. This one in 2015 was the Ebola virus. The Ebola virus it caused about 5,000 deaths worldwide. But when it came over to the United States, and you had 2 cases in the United States, there was another level of extreme fear, and the market went down. It's a little bit hard to see in this chart, but it went down quite a bit in that short term, and it would have been a great buying opportunity. So we have to look at this. Number one, we want to protect the client's accounts at all times. We're always very careful on managing risk well. But also, we're trying to build wealth for our clients over time too. And these types of opportunities don't come up very often. And there is the potential where this ends up being an excellent buying opportunity. So and historically that has been the case when you reach this level of fear. So we're looking at this as an opportunity to potentially take advantage of this and get a little bit more opportunistic. So I want to give everyone some tips to kind of help them make it through this. And when I say stay the course, because sometimes I don't like that term, it doesn't mean that we're not working for you. Behind the scenes, we are managing these portfolios. We are constantly keeping track of all the news, not only of the coronavirus, of the elections, of the economy in general, fundamentals. We're always tracking that. That's what we do. That's what you pay us for. And so we are managing the portfolios and positioning them based off of everything we're seeing. So we're not just sitting back and saying, we'll hopefully we make it through this okay. We are actively managing and looking after the portfolios. But something to help our clients and just people in general be able to stay with a level head and to be able to make good, logical decisions and not panic-based or emotional decisions is to turn off the news. and it sounds kind of funny, but I'm guilty of it too. I remember when the September 11th attacks happened, I watched the news constantly. I wanted to know about every Al-Qaeda and terrorist organization, and I studied that constantly because it just, that fear drives you to either turn to watch the news or get more information. But the news agencies know this, okay? And I'm not saying they're bad, but what I am saying is they realize that the way they get the most income is to have the highest ratings. And if they can get ratings up a lot, then they can get more income from advertisers. And so it's their job to highlight these types of events to the furthest extent possible, and they purposely cause a lot of fear because they know you're going to watch the channel more and they're going to earn more money. But just the fact of you watching the news constantly is creating this negative feedback loop that just gets worse and worse and worse and worse and worse until at one point you can't take it anymore and you sell out of all of your investments at usually the worst possible time, because typically when you have these types of big drops are good buying opportunities. So the other important piece is to make sure that you're getting accurate information. And what I mean by that is sometimes we house our clients' accounts at Charles Schwab, and sometimes people check their Schwab account to see the performance of their account. A lot of times they don't know how to read the Schwab site, and they're not seeing their true performance. They may see what their positions are down in one particular day or over a certain time span of just what they hold, but they're not seeing the true performance of their account. In order to really accurately look at the true performance of your account, you need to go into your client portal, your Morningstar client portal, and that can show you your true total return net of fees. And it's important that you see your actual returns instead of kind of what you're hearing in the news and how much the market is down, because a lot of times it's not nearly as bad as what you think. We're happy to help you. We're here for you to be able to get you on the Morningstar platform if you haven't logged into it yet, but it's just a very good tool that we're providing to our clients where they can gauge the performance of their accounts. Another important point, try not to check your account every 5 minutes. I know it's tempting, I know people love doing it, but in times like this, it can drive you crazy. So it's also super important not to make irrationally fear-based decisions. I could tell you out of personal experience, some of the worst decisions I've made have been when there's been a lot of fear in my life or a lot of stress in my life, and I made a hasty decision at that point. Super important in these times is to control what you, at any time, is to control what you can control. And so you can control doing a good job at work today. You can control managing your expenses. You can control the different behaviors that help you build wealth over time. Focus on those and allow the market to, what's out of your control, do its thing, because it will over time. And finally, in summary, epidemics are historically short-lived. Okay, our portfolios are positioned defensively, and these fear-based, panic-driven drops have historically been buying opportunities. So that's an opportunity. Maybe if you have some cash on the sidelines, and maybe a portion of that we should consider putting into the market. And the last thing for you to know, and most importantly, we're here for you. If you need to call us, give us a call. We're working behind the scenes for you, and we hope this update helps. And if you need anything, give us a call.